Enphase stock is down significantly after they've announced their recent quarter results. It's currently trading at about $151 with a market cap of about $20 billion. Personally, I have added to my position at $143 yesterday. In this video, I'm going to talk about what is the upside of Enphase Energy stock if bought at $151. Before we get started, please note that this is not financial advice. I'm not qualified to give financial advice. Previously, I have done two videos about Enphase, one 5 months ago when it was trading at about $219, and in that video I said I'm not going to buy it at $219, but I will consider taking a position if it goes to $165. And 2 months ago the stock did go to $165 and I have initiated a position in Enphase Energy. Let's now look at the most recent quarter earnings. They made about $711 million of revenue, and the gross profit was about $323 million, which represents 45.5% gross margin, which is almost unheard of for hardware companies. The net income is about $157 million, which represents 20% plus net profit margins, which are again impressive for a hardware company. When I look into the number of outstanding shares, I see 145 million outstanding shares, and a year ago they had 146 million outstanding shares. So Enphase is buying back stock, and that is good for the investors. Overall, the previous quarter results were good, but the stock is down because of two reasons. Number one reason is that the investors are upset with their forward guidance. As you can see on the screen, I put it in a red bar. $575 million of revenue is expected in the next quarter. That's 20% less than the quarter before, and when you compare year over year growth, that's negative 10%. So there is a significant deceleration in revenue which nobody has expected, and that has upset the investors. The number thing that has upset the investors is the compression of gross margin. In the most recent quarter, like I mentioned before, they could achieve 45.5% gross margin, and in the next quarter they're saying they can only achieve between 41% to about 44% gross margin. That's a reduction of gross margin in between 1.5% and 4.5%, and that is not good news, and this has also upset the investors. Let's quickly look at their balance sheet. They have close to $2 billion of cash and cash equivalents and marketable securities, so they have a healthy balance sheet. In addition, the board of directors have authorized to buy back about $1 billion worth of common stock. Based on the current market cap of $20 billion, this $1 billion is sufficient to buy back almost 5% of the entire company. Personally, I have mixed feelings about this. As a growth company, Enphase should focus on growth by acquiring other companies or invest more in R&D to get products with moat. Currently, they only have microinverters that have good moat and are contributing to the good gross margin, but they have other products that do not have significant moat. So I rather Enphase invest in R&D and develop more products that have compelling value rather than buying back shares at a stage where they're still a growth company. But this is what they're doing, so that's what I'm going to consider in the valuation. Let's now quickly revisit what I have shown in my previous video when I was deciding to buy at $165. I've shown two valuations, one with reasonable assumptions and the other one with great execution. In the reasonable assumptions, I have assumed 25% year over year growth, 20% net profit margins, and a 25 multiple, which resulted in a $240 price target in 2027. When I bought the stock, it was at $165, so I was only penciling out about 46% return, which was not great, but it was enough for me to have a starter position. On the other hand, in the same video, I've shown another valuation, which I thought would be possible if they execute very well. In that, I have assumed 40% year over year growth, 20% net profit margin, and a 30 multiple, which resulted in a $508 stock price. When the stock price was at $165 when I bought it, this represents almost 3x, right? So even though in the base case I was looking at 46% gain, I was seeing 3x gain in the great execution case, and that has prompted me to take a position in this company. Now in my base case, I have assumed 25% growth rate, right? But in the most recent quarter, they're saying they can grow negative 10%. So how am I going to justify 25% growth rate year over year when they're only saying they can grow negative 10%? For that, I have to first look at why the growth is in the negative percentage. The management has given a reason for that. They said their revenue in the United States dropped by about 12% due to macroeconomic conditions. So they are continuing to see drop in their revenue in the US market because of high interest rates. But on the other hand, in Europe, they're seeing 25% plus revenue growth. So when I look at this reason seems believable, and even in the United States, probably in the next year, the interest rates would go down and people will be more compelled to buy solar products for their homes, and that's going to reaccelerate their revenue growth in United States. This is also launching products in new territories, so that's going to help their revenue growth as well. So I'm still sticking to my valuation at 25% revenue growth and 20% net profit margin and a 25 multiple to get to $240. So I'm sticking to this $240 price target in 2027 as a base case. And if the stock is at $150, that represents about 60% gain, so which is still compelling. So I continue to believe that the stock is a buy under $165 unless something changes drastically. Before I finish this video, I'm going to show another valuation that's going to consider lesser growth, like 20% growth, which would give them about $5.7 billion of revenue in 2027. The 20% net profit margin is still intact. With that, they can make about $1.1 billion of net income in 2027. I'm still assigning a multiple of 25. People will pay much higher multiple, but I'm only going to pay 25 multiple, with which this company would be worth about $29 billion in 2027. I'm assuming a 2.5% buyback because this company, since they are not delivering on the growth, they're buying back shares to please investors. So that's going to reduce the outstanding share count. This company makes close to $150 million of net income a quarter, right? So that's about $600 million of extra cash that they will have, and they have to do something with it, right? So either they reinvest or acquire more companies to increase their revenue, or they can buy back shares to help the investors. So in this case, I'm assuming a buyback. In my previous cases, I've not assumed any buybacks. So with 2.5% buyback year over year, for the next 5 years, the number of outstanding shares would be about 129 million. And that will result in a stock price of $222. And current stock price is at $150, right? So that is still about 50% plus gain in 5 years. In conclusion, I continue to believe that below $165 stock price for Enphase is a good entry point because we can get 45 to 60% gain in the base case, which will beat the index. But this is not compelling enough to buy hundreds of shares because the upside is not too great in the base case, right? I've done a video on JD in which I'm penciling out 200% gain in the base case. So those are the stocks that I invest significantly, like hundreds and hundreds of stocks. But Enphase, it's not at that level at $165. So I would never buy hundreds of shares of this stock at this price. Let's say if it goes to $100 or so, then I am looking at least a 2x in the base case. That's when I will go heavy. But when I look at a $165 stock price and the upside is $240, that's a gain of 50% in the base case. That's not compelling enough for me to go big. So I want you to keep that in mind. Let me know your thoughts in the comments. Thank you so much for watching.